I think across the board, investment managers would like to say that they're in gold, but a lot of them haven't yet done it, at least not for all their clients. It's one of those things which is work in progress, and they've got to get it done by the year end, because at the end of the year, people are going to be getting their portfolios. They're going to be looking at the portfolio and saying, did you own the asset which beat NVIDIA, which is gold? And they can't not have it. So I think that's the direction of travel from the investment world. The question is, how much are they going to put in the portfolio? Will it be 1%, 2%? I did read one or two banks are saying 5% is the right number. And there was one bank, I think it was Morgan Stanley, even came out and said, now we're 60-20-20.
Clive Thompson's recent gold market analysis offers a sharp and data-backed view of a market entering a decisive phase. He explains that gold's current strength is not a speculative rally but the result of deep structural changes in global finance. Central banks continue to accumulate gold at record levels, while the available physical supply remains historically tight. Thompson points out that each pullback is being met with strategic accumulation from both institutional and sovereign buyers, creating a foundation of sustained upward pressure. This dynamic, he says, marks the transition from a trading market to a long-term revaluation process, one that redefines gold's role within the global monetary system. From a technical standpoint, Thompson highlights that gold has successfully established multiple layers of support, confirming the resilience of its bullish structure. But beyond charts and price action, he focuses on the broader macroeconomic landscape where debt saturation, currency debasement, and geopolitical realignments are reshaping investor psychology. According to him, gold is steadily reclaiming its historical status as a store of value independent of political or financial manipulation. As this revaluation accelerates, Thompson believes we are only witnessing the early stages of a much larger move. Let's hear his clips. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Well, first of all, there was something which made me quite laugh this morning, and I won't name the bank, but it's a very major US bank, came out and said gold could reach $4,000 an ounce. And I looked at the price, it was $3,977. I thought, why do they wait until it's $23 away from the $4,000 mark to tell us it's going to reach $4,000? I mean, that's kind of an easy one. But I suppose they just want to say we predicted it. Of course, you and I and many of your viewers have been saying that gold could go up to 4,000 and beyond, and we've been saying it for years. I think it's gone faster than many people expected, and the whole world, and I get many messages about from people saying this, when's the pullback coming? I'm not in, I want to get in, but is there going to be a pullback, and at what price should I put my limit? And I think the reality here is a lot of people missed the boat, or feel they missed the boat, and so every time there's a pullback, they say, oh, it's happening at last, I'll get a lower price. And then that pullback starts to bounce, and they say, oh, am I missing the boat? They'd rush in, and then it gets pushed to another all-time high. So I think the problem we've got, it's not really a problem, it's just a feature, that gold wants to go higher. There's a lot of people who don't have enough of it. They'd like to buy at lower prices. They're waiting for that lower price. And every time we get a couple of percent off, if you're lucky, you get your order in when it's a couple of percent off. But the reason it's going higher at the moment, I think, is just a general uneasiness about holding large cash balances. And that's not just in dollars, it's euros, pounds, yens, whatever you like, maybe not Swiss francs so much. But those who've got large cash balances feel that they're not sure what tomorrow holds. There's a feeling we moved into a more unstable world where the pronouncement from some president somewhere can suddenly change the landscape for your currency. And people are saying, well, we've got in Europe, we've got political crisis in France. UK, it's sort of edging on the edge of a political crisis. USA, there's a huge political crisis. People say, well, what's coming tomorrow? And the feeling is they've got to do something with their money, which isn't cash, because they just don't. Well, I think we've got a little bit frothy, but that means we're kind of ripe for a little bit of a pullback. But it doesn't mean to say that the bull market is over, not from a long, long way. I think the general trend is still going to be upwards, and there's armies of investment managers out there who don't have enough gold in the portfolio. About a week and a half ago, 2 weeks ago, I attended an investment conference at which many chief investment officers were speaking, from family offices and from some major banks. And I recollect in particular one of the major banks, it happens to be the one I bank with, was speaking, and he was saying, of course, with gold going higher, we've got it in our portfolio, we're recommending it to our clients, and we're using it in our discretionary portfolios. I thought, that's interesting, because my portfolio, discretionary, has got a 0% performance this year. I wonder if there's any gold in it. So I went to have a good look, and there wasn't an ounce of gold in my discretionary portfolio, despite the fact that CIO is standing on the stage telling everybody that they're smart because they put gold into the portfolios. So here's the reality. I think across the board, investment managers would like to say that they're in gold, but a lot of them haven't yet done it, at least not for all their clients. It's one of those things which is work in progress, and they've got to get it done by the year end, because at the end of the year, people are going to be getting their portfolios. They're going to be looking at the portfolio and saying, did you own the asset which beat NVIDIA, which is gold? And they can't not have it. So I think that's the direction of travel from the investment world. The question is, how much are they going to put in the portfolio? Will it be 1%, 2%? I did read one or two banks are saying 5% is the right number. And there was one bank, I think it was Morgan Stanley, even came out and said, now we're 60-20-20, with 20 in gold. Now, whether they're really putting 20 in the gold or that's just a sort of general comment, I don't know. I mean, it's not possible to put 20% in gold for every investment manager on the planet. There's enough gold out there at any price, so that won't happen. But, if every investment manager could get to, say, an average of 2%, and I understand the figures are on average below 1% at the moment, that would push.
Kempke, and you had been talking a lot about gold revaluation. Do you have an update on that and your thoughts on whether in this environment gold could actually officially be revalued to any certain amount by the U.S. government?
Well, first of all, I'll say they cannot afford not to do it. So it's going to happen, in my opinion. The real question which is out there is, or three questions really. One is, will it happen? And I've answered that one. I think they cannot afford not to. The second question is, when will it happen? And the third question is, at what price? Now, there's been a lot of numbers bandied around about the right price, and I postulated that it might be $15,000, which I felt was the right level to, one, cover this year's deficit, a bit of next year's deficit, and pay off the maturing bonds in the next 12 months. So they could have a year or two of grace where the government debt actually goes backwards instead of forwards, because there'll be, as bonds mature, they'll be repaying them and not having to borrow. And as far as the current deficit is concerned, based on my $15,000 level, at least for a year and a bit, they would be able to pay all the bills without running, or all the excess bills above what they're collecting taxes, without running into deficit territory. So the debt of the government would be, for a year or so, maybe a year and a half, 2 years, be going backwards. And it would give a little bit of breathing space to work out what they'll do going forwards. Because obviously the debt cannot continue increasing ad infinitum, because, it can increase ad infinitum, provided it doesn't increase faster than the economy. But unfortunately, it's increasing much faster than the economy. The economy is growing by 1 or 2 or 3%, and the debt is increasing by 6 or 7%. So that can't continue. It's like you have a credit card. You might get a higher salary, but if your debt on your credit card is increasing by 10% a year, but your salary is only going up by 5% a year, you're actually going backwards, and in the end you're effectively bankrupt, because you get to a point where the interest you're paying to the credit card company exceeds everything you earn. And that's the situation and the direction of travel that the government's in. And it's not just me saying it, it's the Bureau of Labour Statistics themselves who say the same thing. So 2 or 3 years ago, about 8% of government receipts went into paying the interest on the national debt. This year, it'll be 18%. So we go from 8 to 18% of the interest paying, of the tax collected going and paying debts. And the Bureau of Labour Statistics, if you read their official budget, which was brought out last January, so it's very, very old, and it's got worse since then. But when they brought out in January, they postulated that they predicted it. If you look at their own numbers and crunch them, you'll find that they're going to, in a couple of years, 22% of GDP. And that's based on an assumed interest rate that the government will be paying, which is significantly lower than the lowest rate they.
Mario Innecco's analysis of the gold market brings a grounded yet forward-looking perspective rooted in monetary history and macroeconomics. He emphasizes that the current environment mirrors the late stages of past fiat currency cycles, where excessive debt and monetary expansion inevitably erode confidence in paper assets. Innecco notes that gold's rise is not merely a reaction to inflation but a structural response to the breakdown of fiscal discipline across major economies. He underscores that as governments resort to endless borrowing and central banks quietly reposition their reserves, gold is naturally emerging as the neutral asset in a world increasingly defined by financial polarization. Innecco also draws attention to the growing movement toward gold-backed settlements among non-Western nations, interpreting it as a sign of deep mistrust in the dollar-based system. He argues that this shift toward tangible value anchors, including gold and, eventually, tokenized gold systems, will form the backbone of a more stable monetary order. As physical demand intensifies and official holdings expand, Innecco believes the gold price will inevitably reflect the magnitude of this transition. His message is clear: the world is revaluing real assets in real time, and gold stands at the center of that transformation.
Yes, it's concerning that there should be a shortage of gold and silver, especially gold, because all the gold really that's been ever mined in history, 99.9% of it, maybe a little less, is still above ground. Yes, there's been some that has been lost, treasures and stuff. But yeah, it shouldn't be difficult to get gold. So what is this telling us? Well, it's telling us that someone, and especially big money, very wealthy institutions or individuals, families, are concerned. And they don't just want unallocated gold from JP Morgan or the bullion banks. No, they want the physical. And I think this is why the price continues to surge, because they're having to find the physical. Paper won't do in a crisis like this. And what is the crisis? Well, we don't know yet, but I think it's ready to come out of left field. Or maybe it's a crisis that people have been forecasting. Maybe it could be AI, and that's something we're going to cover here in a minute, because I have a really interesting video about AI, and I'll talk about it as well. So we've got Bob Coleman on X. He's Idaho Armored Vaults store. He's a precious metals dealer. He says borrowing fee to short SLV shares continues to rise. The rate now to borrow SLV shares is over 9%, while the availability of shares to borrow has flatlined near zero. So, I've also got David Jensen, who I've had on many times on the channel. He reported yesterday cost to borrow SLV silver ETF shares surges today to 8.5% from 2.5%. And he says the following: the borrow fee for the iShares SLV Silver Trust Exchange Traded Fund or ETF have increased to 8.5% from 2.54% on Friday, October 2nd. According to the SLV prospectus, this ETF can operate as a source for bullion banks, authorized participants, not for you and me, of course, to secure physical silver in 50,000 ounce lots by tendering shares to obtain physical silver bars when desired, i.e. the metal is otherwise scarce in the market. By borrowing SLV shares, physical silver can be obtained by bullion banks and other authorized participants without moving the SLV share price higher. Multiple factors, including silver's implied lease rate, spot versus futures price structure, backwardation, we're going to come to that in a minute, daily price action, national mint, silver shortage, and now a surging borrow rate for SOV shares in New York are all now pointing to an intensifying global shortage of physical silver. So what is backwardation? Well, it's when the spot price, or the price for immediate delivery, so to speak, for gold and silver in this case, is higher than the futures price, which means people want the physical now. They're not willing to wait. They don't trust the futures market to deliver. So the price goes higher, the spot price. Usually you have contango, the futures price is higher. And there used to be the late Antal Fekete, or Fekete, I'm not sure how you pronounce the name. He was a professor from Canada, and he analyzed the basis and backwardation, and he said that the fiat currency system would be under threat when we had permanent backwardation in gold and silver. It looks like we've got backwardation in silver, and how can we check that? Well, we need to go to the silver futures quotes on the CME, and the current front month for silver is the December futures, and the last price is 48.32, and the high overnight is 48.55. But if I check here on my system, my trading system, where I can bet on spot silver, the high overnight was 48.67, which is higher than 48.55. So silver is in backwardation. Gold not so much, but there's another bullion dealer here, and his name is Josh Philip Fair. He's the founder and CEO of Scottsdale Mint and co-founder and CEO of the Wyoming Reserve Opportunity Zone Fund Corporation, and he posted this on X yesterday: retail alert. So it's not just the big money or institutional clients going after physical gold and silver, and these shortages are not just in the US, they're everywhere around the world. People are concerned. So he says, whoa, most 7 and 8 figures retail orders in a day than I can remember. So 7-figure, that's at least 1 million. 8-figure, that's at least 10 million. So these are big retail investors. And he says premiums rising quickly. Secondary gold is starting to dwindle. Silver as well. And I've checked this morning here in the UK. The main bullion dealers like Atkinson's. We're not affiliated with Atkinson's, but they've got a lot of out of stock products. The other thing I've noticed over the last few weeks, they've got a permanent message on their website saying due to high demand, dispatch times could be delayed by up to 5 working days. So that's not normal. Gold Investments, who I'm affiliated with and I highly recommend. Yes, they've run out of some of the Britannias, but they do have 2026 gold Britannias for immediate delivery. So their sovereigns are there too. So I don't think it's too late to get out of Dodge or get out of fiat into gold. And if you want to find out more about the precious metals bull market, I'm going to put a link up here to an interview I did yesterday with Kevin Wadsworth from northchartsbatcharts.com. He's a technical analyst, And they've been right about gold and silver for the last few years. And Kevin told me yesterday that he sees the precious metals bull market continue for around 10 years, for the next decade. So as I said, it's not too late. It is going to get more and more expensive, though, to get gold and silver.
The future of gold seems to be heading toward a historic revaluation, one that could redefine how global wealth is measured. As nations move away from the dollar and into tangible reserves, the true value of gold may no longer be dictated by paper markets but by its real-world scarcity and monetary importance. The groundwork for a multipolar financial order is being laid, and gold is quietly being positioned as its foundation. When this shift fully unfolds, the price we see today could look like a distant memory of an undervalued era. What do you think? Are we on the verge of witnessing gold's biggest breakout in history? Do you believe this silent accumulation by central banks will soon turn into a global reset of real value? Let me know in the comments, share your thoughts, and don't forget to like and subscribe for more deep market insights.